Good morning, trading reps, advisors, and clients and partners. Welcome to today's morning call. I'm Joshua, the head of research. I'm going to give an update on the macro outlook, and then we're going to talk about Ionix brands, which is one of our top picks today that proxies the consumer cyclical sector. Okay, in terms of our broad asset calls, we're still sticking with the overweight stocks and neutral to underweight bonds, neutral weight commodities, underweight gold. But some updates for you guys. For the US, as you know, we are neutral on it. We have talked about the US before, but I just want to talk about the non-farm payrolls print that came out on Friday, which was 74,000 versus 194,000 consensus. So the numbers is a disappointing one. The unemployment rate did fall to 6.7, but that was mainly due to people leaving the workforce. Now, this is 1 month of data does not make a trend, and we typically look at 3-month moving averages, right? And so from that angle, I think one need not get alarmed unless we get 1 or 2 more prints of this kind of momentum. But then again, back data tends to be revised, has been revised upwards. So even though you might get a not so good print, like even for December was not that great, November got revised up. Okay, so when we look at the forward-looking indicators, we are seeing lengthening supply delivery times. That means suppliers are taking longer to make do on their supplying, which means that they're busier. That's a leading indicator. We have shrinking inventories. We have robust new orders, right? So we still have positive macro conditions, and it suggests positive macro conditions ahead and a continued bull market. But as Ken pointed out last week, we think the odds for S&P 500 correction is rather high on his technical indicators. Now in the Eurozone, we are sticking with, we actually upgraded it to an overweight from neutral weight, because although the recovery is patchy, it is proceeding in the right direction, with industrial production, retail sales, and PMIs all turning positive, but at very, very low levels. Okay, so it's a fragile recovery. Inflation actually is very low, and low enough to cut rates further, and that's a plus. Now, the earnings outlook for European companies are quite strong. Actually, most analysts are forecasting a strong rebound, and for about 25% earnings per share growth. So although we've had a good rally from European stocks last year, we actually do expect it to continue based on very strong earnings growth. This is because many of their companies are global MNCs, and they have had weak European performance, but then the Asian performance, emerging market performance, rest of the world performance has been pretty good. And we think that with a rebound in Europe, then they might even see further upside to their earnings. Now, Japan is still an overweight, maintained. Forward-looking machine orders are very robust. Industrial production and PMI is positive as well. Now, the first half looks forward to structural reform, and earnings growth there is, consensus is about more than 13%. Now, I think the most significant thing we're going to do, we're going to have to highlight to you guys today is China's downgrade to a neutral weight from overweight. I think China's been a huge learning experience for us, because, as you can see, the CSI 300 just cannot rally, despite China's economy holding steady. It's actually rebalancing from more services from manufacturing. Corporate profits are rising. You have cheap valuations. We have structural reform from the third plenum. But the fact that it just can't rally is very telling, and I think we can't underestimate the macro risk from the local government debt, and I think that is a key global macro risk, actually. So we have been warned already. by the fact that PBOC has to constantly intervene into the liquidity markets shows that the system is teetering to a certain extent. And I think all eyes will be watching on how the Chinese authorities deal with removing all these bad loans from the banks, which are clearly weighing down on economic growth, clearly weighing down on their ability to lend. And I think the situation bears watching. Well, it's very hard to say which way it'll swing, right? Because I think the Chinese government does have the firepower to bail out the situation. But until that day comes, this is going to be a bit of a risk. So this is showing some indicators of what we talked about. GDP growth on a quarter-on-quarter basis is pretty stable, oscillating between 6 and 9% annualized rate. On the chart below that, you can see supplier delivery times, which is the black line, actually turned positive, which means supplier times are higher, getting longer. And then you can also see inventories pretty low, contracting. Okay, this is actually a good forward indicator on the economy. On the right-hand side, on the top graph, we have industrial profit, which has rebounded over the course of the year. And I think these three graphs taken together, give an indication that the economy is not doing that badly, right? But then we have this risk, which is shown in the bottom right chart below. The red line, as you can see, loan to GDP has had quite dramatic surges. And the efficiency at which these loans have been deployed are in question right now. No change from our views of ASEAN. I think Thailand is still a political risk. Indonesia has, I think there is some upside risk despite our neutral rating because the current account deficit is starting to narrow as weak rupiah boosts exports and cuts imports. Things actually could be looking up. But having said that, this is an election year. Excuse me. Singapore and Malaysia continue to be standouts in Asia, standout economies because they have both external and domestic drivers. Fiscal position in Malaysia is also under control. Now in Singapore, the STI is probably, I think, the cheapest market compared to all of ASEAN. And it's trading at about 13.4 times PE, whereas the other three are more than 15. Okay, so it's got a good macro outlook and it's cheap. So I think the Singapore market could probably outperform its peers this year. It's also a safe haven in it's a safe haven in an era of macro and political uncertainties in Asia. So if you look at the STI trend, it's volatile, but it's an unmistakable uptrend with higher lows. So we have a buy and dip strategy. Our stock picks for the year. We have gone through DBS, Keppel, and M1 already in previous webinars. Just to give a quick summary, DBS is going to see net interest margin expansion because it's got the highest proportion of cheap funding, right, in the current account and savings account deposit. And with QE tapering, we expect long-dated yields to rise, while the short end remains anchored by the Fed's funds rate. So that implies net interest margin expansion. And DBS also has the cheapest source of funding, so we expect the impact to be greatest there. Keppel, we have resilient O&M margins from efficiency gains, strong order wins, visibility all the way to 2019, and a dividend yield of 4.4%. Baustit, we did a webinar in November, so I'll just rehash that for you guys. There's a strong record order books in the energy and industrial design and build, and it's pretty undervalued with catalysts in the potential JV and the potential REIT and Iskander JV. Okay, so Baustit, Keppel, and Ionix brands fall under the sectors of industrials and consumer cyclicals, right? The first two being industrials. Ionix is the consumer cyclical. These two sectors tend to benefit when growth is rebounding, which is the situation that we see ourselves in right now in terms for global growth. But we also have a secular trend play, which is M1, and that is data monetization of tiered plans and the doubling of the excess usage charges. We think that the telcos are going to put in some earnings growth this year as well. Okay, so I'll pass you on to Yongkai right now. We'll talk about Ionix brands.
Hi. This is Yongkai here, the analyst for US equities. So today I'll be talking about Ionix Brand Group. If you recall, I actually presented on this company before in August. Yeah, but because this is currently our top pick for this quarter, so I'll be giving a quick refresher. Okay, so the share price is now $39, which is up nearly 15% from August when we first issued a trading buy report. This is actually roughly up around 70% from the 52-week low at the very start of January last year. Market cap is $2 billion, and price over forward free cash flow multiple is 9.4 times, which is really attractive. Okay, so if you remember, Ionix Brand Group focuses solely on marketing, advertising, and licensing its portfolio of 33 brands. So all in all, it chalks up a total of $13 billion of global annual retail sales, which ranks it the second global licensor only after Disney, and actually ahead of other more renowned brands such as Calvin Klein, Mattel, and Warner Brothers. Ionix itself bears no operational nor inventory risk. So yes, the sales, sourcing, warehousing, nothing of this sort under its business model. Similarly, because its assets are all intangibles, it's all trademarks, so there is little need for any working capital or capital expenditures. So you can see I've listed some of the more renowned brands here. We have Echo, Peanuts, OP, and Umbro. Some of the, if you have traveled plenty, you might have recognized some of the others as well. There's only two licenses that Ionix deals with. One is direct to retail. So exclusive rights is negotiated for one national retailer for a broad range of categories. For small Walmart, we only deal with OP, then Skin, Target, Mossimo, for example. These top retailers represented 30% of 2012 revenue. The second kind is traditional wholesale license. Rights to a single or small group of categories are granted to a wholesale supplier. So Li and Feng, for example, will distribute these products to Walmart, Target, Kohl's, for example. So this company itself represented 6% of 2012 revenue. Just a quick gloss through of what's the target upside. We're looking at 16.7% from today's market price. Yeah, and we rank it a trading buy. So we just move on to the company fundamentals and investment merits. Okay, firstly, this Ionix Brand Group, they have very high recurring revenues, and these are very high margins as well. Contractually guaranteed is around $800+ million. If net sales target is not met, they will still have to be paid this amount. 2012 revenue was $350 million, yet only 148 employees required. Okay, so in other words, you are looking at around each employee being responsible for $2.5 million revenue and more than $1 million of free cash flow. So again, we look at the contractually guaranteed minimum. This is more than twice of that of 2012 revenue. Gross margin is 100% because there's zero inventory. It's purely, entirely licensing royalties. EBITDA is 64% and net margin is 35%. To put this into perspective, Macy's, one of the leading US retailers, and which reported better forecasted 2014 earnings, has only gross margin of 40% versus Ionix of 100%. Similarly, Macy's net margin is a low 5% versus Ionix 35%. Next, management is very disciplined when it comes to capital allocation. Every acquisition is weighed against buybacks. So yes, it spends nearly $2 billion on brand acquisitions since 2005. But last year, 2013, there is no new acquisitions. Instead, it's actually spent $400+ million repurchasing its shares because it thinks it's undervalued. So this repurchase made up 22% of outstanding number, and for the price of $28 per share, Currently, share price is actually trading around $40, which is 40% higher, reflecting a very good, excellent timing on the part of the management. Customers, which are really with the retailers, have a very high demand for them as well, because they can brand their own merchandise and still earn high label like private label like margins. Then this arrangement also avoids price comparisons among different retailers, because now you have e-commerce. People are very afraid of this showroom phenomenon where you go in to a retailer, you see what you want, and then you go online to Amazon to purchase it at a cheaper price. Under this direct-to-retail license, this doesn't happen at all. So our royalty is average only 3% sales, which is a reasonable percentage, yet allows a premium positioning and pricing. Ionix has successfully branded $7 billion of the retailers' unbranded or private label programs in the last 5 years alone. So, okay, let's see. The retailers can either sell their products for $10, or they can brand it, say, OP, Umbro, and then you sell it for $10.30. This definitely is more favorable to them, and they still get to keep a very high margins. The very good thing about Ionix is that the responsibility of marketing and advertising lies solely with it. So retailers just have to focus on supply chain management, retail sales, and then these are actually their historical strengths. The founder and CEO, Nelco, have 6 brands that represents $1 billion each of annual retail sales, and the retailers have always renewed this every year. So just a quick overview. Walmart, so you have your OP, you have your Dansky Now and Starter. Then for example, your Macy's, your Material Girl, which is started by McDonald. Then you have a Costco. Actually, most of the major retail brands are represented here, and this is just a very quick gloss through only. Acquisition criteria is very well established. Average age, they are looking for more than 50 years. And then they can be in multiple product categories. They also require that the target consumers mostly recognize it, and then 2/3 of the purchase price and guaranteed minimums. Okay, so in the one understated benefit from this brand acquisitions is that they actually recognize the tax benefits. So they get to amortize these intangible assets for 15 years. At the same time, there's no corresponding GAAP expense because the trademarks are deemed to have indefinite useful life. So again, you have tax savings, but no GAAP expense. $24 million of it is attributable in 2012. So for example, for the first case study, Umbro was acquired for $500+ million in 2007 by Nike. This is actually a loss-making brand under Nike, okay? But under Ionix, because they are just solely in charge of collecting the licensing royalties, they actually will be making 75 to 80% EBITDA margins on $40 to $45 million royalties, and they are purchasing Umbro brand for less than 40% paid by Nike in 2007. In the second case study, you have your United Media, which the main brand is Peanuts, is acquired for $165 million. Okay, so let's say, for example, in this case, Ionix, they have already arranged to release a Peanuts feature film in 2015, and they collect a royalty of the gross without any investment at all. Okay, so this is just something that they last reviewed in around 2010, the acquisition track records. You can see that those, let's say for example, OP maybe now is not as strong brand as, let's say, 10 years ago, but they acquired for a relatively cheap $54 million. And in the 4 years, in 3.5 years, they actually recouped 3/4 of the revenue already. And bear in mind that their EBITDA margins on this revenue is around 60+%. Growth strategy is very strong as well. Internationally, the revenue contribution is 33%, up from 6% in 2009. There's many 50/50 JVs in China, India, Canada, Europe, and Latin America. Okay, so even though upfront they have to deconsolidate the revenue, but they receive a cash payment and vested local partners, and then the earnings will be recognized under equity JVs. These local partners are very reputable. For example, Silas Cho and family, they are behind the revitalization of Tommy Hilfiger. Michael Kors was a relatively unknown brand 10 years ago as well, but now today is listed on NYSE and it's a $16 billion company. Reliance Industry in India and Fadi Group, Latin America. Latin America revenue is actually up 56% year over year. an increase from $1.7 million before JV formation to $10 million in 5 years alone. Ionix China, they actually have equity ownerships in 11 companies, and projected growth will be to 700 plus stores. The new JVs actually have puts and calls that Ionix can repurchase 5% interest and consolidate the international results so that we can observe the revenue growth as well. Australian JV was set up recently, and more JVs are expected to come. The international segment is expected to contribute 40% revenue in 2014, up from 33% currently. So this is just some graphics, diagrams for illustration. Previously, in the old stores, maybe you have limited floor space, no brand signage, and very weak brand packaging, where it's very haphazardly displayed. But under the new, after the makeover, you have a very strong presence, and because the retailers have exclusive rights over their brands, so they grant it prime retail presence spots. For Canon, for example, this brand, in 2008 there was only 7 product lines, but in 2010 they were expanded to over 20 plus. Similarly, for candies, there were only 782 stores in 2005, but in 5 years' time they will expanded to 1,000 plus stores. Bear in mind that Ionix only license out the brand, so it doesn't have to source for the store leasing or inventory. Yeah, these are actually done by its own licensees. Lastly, one of the merits is they have very optimized capital structure, so it has some debt and very cheap as well, and 4+% blended interest rate. This facility actually requires you to pay down $60+ million every year, which is only 30% of 2013 free cash flow. So this amount will help to keep the debt load in check. There's also very huge investor demand as well for its convertible notes. Effectively, they are actually at 53 and 75% premium, and they are paying very low rates of 1.5 and 2.5%. So, quick look at historical financials. Revenue has actually expected to go from $81 million in 2006 to $400+ million this last year, 2013. The year hasn't ended, but the revenue management has actually guided that they are on track to increase and hit the guidance. Okay, so all in all, you are looking at a 28% CAGR, even factoring the 08-09 financial crisis. Free cash flow is higher than net income and grown 26% CAGR as well. So this is higher than net income because there's of substantial deferred income taxes and amortization of convertible notes discount. Okay, this amount, 26% CAGR, is in line with the revenue growth rate, and this very high quality recurring free cash flow, which for 2012, which makes up 51% revenue, and enables Ionix to pursue value creating acquisitions or repurchase shares. So again, the DCF valuation, if we ignore the stock-based compensation, we deduct it from the free cash flow, and we use the medium-term WACC, which factors in 10-year treasury yields of 5% versus 3% today. 3% terminal growth, you're looking at $3.2 billion market cap. If you assume that all the convertible notes are converted, which is actually one tranche is really in the money, and the second one is only about 3% away from it. So if you're looking at the $700 million convertible notes are both converted, a fair value of $45 is obtained, which is 16.7% above today's market price, and this is a trading buy rating. So in conclusion, this company focuses entirely on marketing and licensing its 33 consumer brands, which has chalked up $13 billion of global annual retail sales. This ranking is number 2 global licensor only after Disney, and ahead of more reputable brands. They bear no operational non-inventory risk, so doesn't have to worry about sales, sourcing, or warehousing under this business model. It doesn't need any capex or very little working capital as well, because these are all intangibles. As long as well managed, these brands will give a perpetual recurring royalty. And this royalty that is contractually guaranteed. Even if net sales target is not met, they will be locking in $800+ million as of 30th June 2013. Gross margin is a high 100% because there's no inventory. EBITDA is 64% and net is 35%. So management has also repurchased 22% of outstanding shares since the start of 2013 for an average price of $28, which is actually and today's share price is 40% higher, reflecting the good timing on the management and it also indicates that how disciplined they are on capital allocation. They are willing to forego acquisitions if the share price is a better buy. Royalties average only 3% sales. These are very reasonable, and retailers are all very eager to sell the branded merchandise and still earn high private label-like margins. Ionix does all the marketing and advertising, so retailers just have to focus on supply chain management and retail sales, which is their strengths. International revenue contribution forecasted to be 40% of this year, up from 6% in 2009. Reputable Ionix JV partners such as Silas Cho and family, which is responsible behind Tommy Hilfiger's and Michael Kors. Free cash flow and revenue has historically increased at 26 and 28% CAGR since 2005. Just bear in mind that even though a very big part of it comes from acquisitions, the share price of Ionix actually increased around 7 times since 2005. So a lot of these acquisitions are actually earnings accretive and adds value to the company rather than dilutive. Okay, and with that, we have reached the end of this Ionix presentation. We are open for questions. So we have a first question. Can we talk about direct to retail and traditional wholesale licenses again? Okay, so the reader asked to elaborate on it. Okay, so again, direct to retail, the retailer has exclusive right to a particular product category. So for example, Walmart's, if they already negotiated this license with OP to do slippers, then the particular design, the particular slipper can only be found in Walmart's, nowhere else. Whereas if you're a traditional wholesale, then that means that you're essentially getting a wholesaler and they have the right to distribute these products in any retailers, in any stores, overseas, internet, whatever platform that benefits them. Okay, then we have a second question. In your universe of stocks, what alerted you to this company? How do they compare to like direct competitors? Macy's may not be a good comparison as they have different business model, correct? Thanks. Okay, as far as I'm aware, Ionix is the only company that derives 100% of its revenue from licensing. Okay, so you have a lot of companies. For example, you have Disney, you have Calvin Klein, Warner Brothers. Yes, they do have licensing revenue, but licensing revenue is a really small part of the overall business. So if you want to look at a licensing pure play, where they just 100% of the revenue comes from royalty stream, Ionix is the company. Okay. Okay, maybe just to add on, yes, Macy's is not a good comparison. Why? Because if you realize that in the last the last earnings season, some of the companies, some of the retailers reported that they have higher revenue but lower earnings because of heavy discounting. Such issue wouldn't happen to Ionix at all. If the retailers record higher revenue, Ionix will receive higher revenue, and chances are it's going to receive higher earnings as well. Okay. There's another question. Is it possible to buy Ionix through CFD? If not, what other ways I can buy the stock? Okay, because this is a US listed company, so you can actually just go straight to our Poems platform and purchase this US shares. If alternatively, you can also approach Rumizer. There shouldn't be any problem as long as you have signed the W8 band form.
Yep. Hi. Question here. Do we have a 2014 Outlook report including the stock pick list? Well, the webinar slides are actually downloadable. Okay, so if you go to unifilip.com, yes, unifilip.com, the slides are downloaded from there and the stock pick list is there. So today's slides basically. As this is our style is that it's a very dynamic thing, right? Macroeconomics. And once you do a big mega report, it gets out of date pretty quickly. So we're going to do it week by week commentary.
Hi. So sorry, I think I didn't manage to follow up on the CFD question. So there's a question on whether we can buy Iconics through CFD. As of now, that is there's no this counter isn't available through CFD, but maybe in the future, you can buy Iconics through CFD. Another question is whether Iconics brand is a Nasdaq stock. Yes, it is. It's listed on the US Nasdaq Stock Exchange.
Okay, we have some questions on S-chips like Yang and Midas. Unfortunately, we don't have coverage on those. And we also have questions on whether the top 4 Chinese banks, do we see a major correction? I think, the banks are all trading very cheap already. And whether they'll have a major correction, I think the downside risk is there with the bad loans, and the NPL ratios are far too low and can have high chance of going higher. Having said that, if the Chinese government takes all these bad loans off their books, that could prove a positive catalyst. It's just pretty much a coin flip the way we see it right now. Okay, we have another question on China. Basically, the local government debt is valued about 20-30% of GDP. Is that the case? And their reserves are high. Well, see, China does have very vast reserves, and the debt is at the local government level, right? So the central government could take on that debt, and then it would pretty much be a socialization of the debt, and it would be not detrimental to China at all because its debt to GDP ratio on the whole is actually pretty low. Okay, it's just that there's a high concentration of this risk at the local government level. They have poor ability to raise revenue. Their tax revenue model is basically not working. Okay, so it's a case of having a plan to take these loans off the bank's books, basically, and basically until some kind of central government bailout, in our view. But until that comes, it's a risk, and I think we should highlight it. Okay, our take on Thailand is also, well, I think we have the view that this is coming to a situation where it does not seem that a democratic solution is possible. And I think that means the military is probably going to have to step in. When we speak to our Thai colleagues, they also feel the same way. However, it's kind of like normal for them, for the military to step in. And I think it's a volatile situation, So again, politics, how do you quantify it? How do you predict which way it's going to go? I think, that's why we're maintaining an underweight on Thailand. Okay, there's a question here. Why is the STI overweight when the Dow is underweight? Will the impending drop in the Dow affect the STI? Would it be better to wait for the Dow to correct before you buy Singapore stocks? That is a very good question. And it's one where we're actually quite undecided about whether a correction in the Dow is going to have a severe impact on the STI or not. I mean, if you notice that the two are positively correlated, but the magnitude of correlation is not as strong as it used to be. The S&P, the Dow has rallied like almost 30% last year. The STI has gone flat. Okay, so if the US market's correct, will that entail a large correction on the STI? I think it's really hard to say because the STI hasn't even rallied at all, you know, and given that, that is why we have the STI on an overweight, because on a relative basis, it's a developed market that has not rallied compared to all the other developed markets, and compared to all the other EM markets, we're definitely in a more resilient position than them, right? With cheap valuations and a positive macro outlook. So would I wait to buy Singapore stocks? Actually, I don't know. I think personally, maybe buy half, right? And then you can scale in again if there is a correction on the Dow.
Hi, so we have a question on Ionix, whether there's any dividends. Ionix has no dividends. Okay, why? Because its capital is either used to repurchase its shares, like 22%, we retired 22% of outstanding shares last year, or to pursue acquisitions. So every acquisition, they are buying it around the price of 10 times free cash flow, and this is actually this will actually set it on a growth path. Next, we have a question. What is the price to book ratio for Ionix, and whether debt ratio is healthy? So, assuming the conversion of the convertibles, the price to book is roughly 1.7 times, and debt ratio will be 0.7 times, which is really healthy.
Hi there. There are some questions on. There's one question on agri-commodity stocks. This question says that it seems to go down. What are our views on Wilmar? For agri stocks, there's a slight consolidation, as you can see recently, due to the consolidation of CPO prices. That said, we have always been neutral on CPO price outlook. I believe that the higher supply coming from the South America, for higher supply of soybeans coming from South America, will actually cap any upside in terms of CPO price. So upstream players like Golden Agri, we are pretty neutral to that. As for Wilmar, because of its diversified business segments, even though their plantation segment is exposed to CPO price, we feel that overall they will be neutralized by its other segments in soybean crushing, sugar, as well as the palm refining business. So our call, so we see that the fundamentals of Wilmar still remain strong. Our call for Wilmar still remains at accumulate. Thank you. Josh,
Okay, question on Baustit. Okay, any catalyst? Well, that is the main thing. There are plenty of catalysts. I think the main one is that they intend to read their industrial portfolio. Okay, and that portfolio is, given the pipeline of properties coming in, it looks to be valued at about 400 over million, which is already 50% of the market cap now. Okay, now if Baustit also has a very strong net cash position of almost 225 million net cash. So if you take the market cap, you less off the net cash, you less off the property portfolio, you're actually going to be paying like less than 7 times earnings for the underlying businesses, right? And the underlying businesses are regional or global leaders already. Like, for example, the energy business for direct fired heat processors, there are only 4 in the world. Baustit's one of them. That business has record high order books, right? Due to the shale gas boom, and the industrial portfolio also has, industrial design and build, the other business, also has record high order books. So, with record high order books, I expect earnings to be good going forward. The building up the property portfolio to REIT. And then there's one more catalyst, which is they have a piece of land in Iskandar, Nusajaya. Now, if you know Nusajaya, it's not really a place in Iskandar where industrial properties are going to be concentrated, because it's very much a residential and theme park area, medical facilities. Okay, so the industrial land there is going to be very coveted because it's going to be close to places like Horizon Hills, Legoland, Hello Kitty, where people want to live actually. So they have this JV for quite a large piece of land in Iskandar, and I think because there's also no official plot ratio in Malaysia, this industrial land can really be built to maximize value. So I see a few catalysts going forward actually for past it. And my target price is $2.05. Thanks.
Well, there's a question on Keppel Corp. Well, as a whole, we still see strong fundamentals for the offshore and marine industry, and despite the recent slight fall in capital price, we feel that any consolidation in Keppel Corp's price will be a good chance to go in, because fundamentally there's still not much changes. They're still taking in orders. Order book is strong. We expect order wins to hit a target of 7 billion this year.
So we have a question. Okay, we have two questions. One is, what is a good point of entry for Ionix? And secondly, is the current price valuation of Ionix considered low or high? So I'll just quickly bring you all through to the DCF valuation again. We think that this is actually quite a good point of entry. Why? Because we are using actually very conservative assumptions. Terminal growth of 3%. Okay, even though for the past 7-8 years, the CAGR was around 26-28%. So this is actually a fraction, very small fraction of the historical growth. Okay. Secondly, the actually still has a lot of firepower. It's roughly around $600+ million of liquidity that it can use to purchase brands. So we just will do a very quick back of the envelope. $600 million when you purchase the brands, it can generate a free cash flow of roughly $60 million. So $60 million, if you multiply by around 15 times multiple, you're adding a $900 million valuation to this company, even though it doesn't have to issue any shares. Yep. So at 17, we think this 17% calculated upside is actually pretty conservative, and the company itself actually went up around 15% since our last trading buy reports in August 2013. So there's still plenty of money to be made. Yep. If you want to find out more, you can actually just log on to our Poyon's website, go to the Poyon's, log into your accounts, and then go and download our trading buy reports issued in August 2013 for Ionix Brand Group. Okay, so that's all we have for you for today. Please log in. Please remember, next Monday we have the same webinar coming up again. Thanks for attending. Thank you.